As you assess events from last Friday, how concerned are you?
I'm not overly concerned, but what I'm worried about is actually the level of complacency in markets. So you look at valuations in equities, you look at just the VIX finally moved up a little bit. The market isn't in euphoria by any means, but nobody's worried about anything up until yesterday. And it's very minor moves in markets, but it feels a little more significant when you see the VIX moving from 11 to 15, gold moving up, yen going down. It's the first signs that the market's worried about something in a long time, actually, since the election even.
The VIX still at a relatively low level, Patrick. So I'm guessing you think there's room to move higher. Where else do you see, or where do you see the most room to move higher? Where do you see the most room to make money here as this complacency kind of comes off?
Well, the most high conviction trade we have right now is being short U.S. equities at 3.1 times book value. European equity, if it generates $1 in EBITDA, trades at €8 a share, or a euro in EBITDA, €8 a share. In the U.S., if it generates $1 in EBITDA, trades at $12.50 a share. It's just the extreme discrepancies in multiples people pay for U.S. companies versus European companies. We're long gold right now, and we're funding that in yen. So we're pairing two safe havens off against each other right now. And I think that's a very good risk-reward trade. I don't really buy the yen safe haven characteristic. It always works. But the Bank of Japan is buying all of the Japanese debt. Eventually, that turns into a monetization of that. And gold, I think, will continue to display the safe haven characteristics it always has. So you can fund a gold purchase in yen for no cost, essentially.
What's your preferred method of getting short U.S. equities? Do you just short individual stocks? Do you short index futures? Do you buy ETFs? How do you work that trade?
Our largest short's in the Russell 2000, which has had a huge rally since Trump was elected. It's trading at 26 times earnings. S&P is very expensive at 19 times earnings. Russell 2000 at 26 times earnings. So the cyclical growth there, I think that's going to deliver, but it's all in the price right now. So Russell 2000 is our largest short. Also short some of the defensive sectors. Utilities trade at 18 times earnings, and I still don't get my head around why utility trades at 18 times earnings and Alphabet trades at 18 times earnings. I can see where the growth comes with Alphabet, but utilities aren't going to grow their way into those kind of multiples.
You mentioned some of the defensive plays. This is yen, gold and oil all rebased to 100 from the start of this year. What needs to happen to change direction for markets? Because nobody seems to think that there's going to be a big volte-face from Russia today. The rhetoric in regards to North Korea is rising. Is the smart trade to take some protection in the form of these markets? Or is that wasted money? I
almost think it is. I think the safe havens are still priced in a deflation premium that's not there. So we had deflation risks a year ago, and we've started to see a reflation unwind of some of them. But U.S. Treasuries are yielding 2.3% today. Normally, a Treasury yields the nominal growth of the United States. And if you're looking at 2% growth and 2% inflation, that would put a Treasury at a 4% yield. So I think safe havens are still overvalued. Gold's our preferred one. And if you pair that with yen, that's a no-brainer right now.